Hello and welcome to another episode of the Money Matters podcast. My name is PJ Patterson. Thank you for joining me. Today I'm going to do part two of a two-part series around paying off your home loan sooner. In part one, I had a little bit of a rant about some of these folks you see out on the internet who are talking about paying off your home loan in 7 years or 10 years or whatever their number is. And the reality is that there's only one way to pay your home loan off sooner, and that is simply to make extra repayments. There is no other way. So if you go back and listen to that podcast, part one, about paying your home loan off sooner, you're going to learn that a lot of what is out there, and they're talking about paying your home loan off sooner, what you end up with is the same amount of debt or maybe even more debt because you've gone off and bought investment properties. And there's a strategy around using the rental income to pay off your non-deductible debt. So it's really about paying off, what they should be saying is paying off deductible debt versus non-deductible debt. So I'm not going to go into that today. What I am going to talk about is two of the most powerful ways to help make extra repayments or help you pay your home loan off sooner. And that is the good old offset account and the good old redraw facility. Now, there's been a lot of talk recently in the Australian press about redraw. There's been a few banks that have just randomly gone in and made amendments to clients' offset or even redraw accounts. So I do want to allay any fears. Most lenders do not touch them. They don't mess with these accounts at all. And any monies that you have in there are yours, will be yours, and should not be touched by the lender. But first of all, what is a redraw account? So a redraw account is where you have a home loan account. It typically needs to be on a variable rate, although there are some products out there that allow you on fixed rates to make extra repayments. And you have a couple of options. You can either set up a regular deduction from your pay, where your pay might deposit directly into your home loan account, or you can set up a transaction from your bank account to your home loan account, thus increasing the amount of principal that you've paid off on the loan. And because you, in doing what I've just described, what you're doing, and if it happens frequently enough, what you're doing is you're building up the amount of redraw. So you're making extra repayments effectively that the lender, the bank or the lender, will allow you to quote unquote redraw. So in an emergency, effectively in an emergency, if you needed to tap into those funds, you could get onto your internet banking and you could ask to redraw the available balance. So it's a great way to actually save money. Now, I'm just going to run through. I don't actually have a redraw calculator, but what I do have is an extra repayment calculator here on the screen. So I'm just going to make this bubble a little bit smaller. And for those of you who might just be listening to this on the podcast channel, you can obviously review this when you're in front of a device that has a screen, but otherwise I'll walk you through it. So this little calculator just sets up, pardon me, a transaction where, in this case, I'm going to change the loan amount to $500,000. I'm going to put the loan term at 25 years. The interest rate I'll just set at 4%, which obviously it's a little bit high for the current climate. And at the moment, as you can see, there are no additional repayments. So for those of you, sorry, there's a $100 one in there. I'm going to make that zero. So for those of you who are unable to see what's on the screen, there's just a calculator set up: loan amount, loan term, interest rate, and the frequency of repayment. And then there's a box for additional repayments. And across the screen, it tells us how much the repayment is, what the total repayments are, what the total interest is, and what the total savings will be, depending upon the amount of additional repayment and the number of years saved. So it's set up on a 30-year term. Now, here's a little tip, and I think I mentioned this in part one, but here's a little tip for you. If you actually want to pay your home loan off sooner, knock the loan term down to 25 years when you take out the mortgage. For most people, it doesn't make a massive difference in the repayment. Now, I get it. For some people who, if your incomes aren't particularly high or whatever, you're on a dual income and everything you earn is either spent on your lodging or your family, I totally get that. But for those who have extra income or a larger income and a buffer, you can quite easily look at setting your loan term to 25 years. Anyway, I'll just do that quickly for you. So on the $500,000, 4%, on a 30-year term, the repayment's $2,387 per month. I'm just going to knock that down to 25 years just to show you what that does to the repayment. So that takes it up to $2,639. So 25 uh, 2387 to 2639. So that's what, about 270-ish, 260, $270 difference. Look, for most people, that's per month, by the way. For most people, 200, let's just call it $250 per month, just to use a round number. Most people can find that if they really, if they really needed to, they could find that. And so there you go. You've just knocked off 5 years off your mortgage simply by doing that. So let's talk about additional repayments. So again, 30-year mortgage, $500,000, 4% interest rate, monthly repayment. If you just put in an extra $100 per month, that would knock off, in this calculation, 2.2 years. That is a long time. That's 26 months, I think, 27 months, something like that. So that's going to knock off 26 months, actually, what am I talking about? That's going to knock off, quite a substantial amount of time, just $100 additional per month on these metrics. Now, if you were to, let's really jump that up, something like $500 additional per month, that is going to knock off 8.4 years. So just by taking the 100 to 500, you knock off 8 years off your mortgage. This is how you would use a redraw facility to actually do that. So again, with redraw, what you're doing is you're putting the money directly into the mortgage account. It is, if it's a loan account set up with any of the lenders these days, they all have redraw accounts. You can chuck money straight into that account. So if you do a double whammy of this, let's say you do 25 years and you were to say just settle on $250 per month, which again, not a huge stretch, that would save you 3.5 years just in doing that. So really what it's done is it saved you about the same amount with about the same amount of money. A little bit more, actually, because 250, I think in the other metric, the amount went up by 250. So that's roughly the same. Anyway, there you go. That's the redraw facility. Now let's talk about offset. Now I've got another little calculation set up here that I want to show you, which is, and just for the sake of similarity, we will adjust this to 500,000 as well. On this screen, what I'm showing you is, and I've just picked a product randomly. I've just chosen ANZ Bank because of my software. A is, at the first letter of the alphabet, and just grabbed a product which has an offset account. So ANZ has a professional package, and typically offset accounts come with professional packages. Sometimes you can get them without having to pay an additional fee. But in any case, this product with ANZ is called the Break Free. Again, many lenders have these. They're very good. So first of all, offset accounts are simply a bank account. That's all they are. And they have a feature or a function called the offset. And what that means is for every dollar that's in the offset account, it reduces the mortgage balance by that same amount. So in this example, I have a $500,000 mortgage set up over a 30-year term, and the average offset balance is $100,000. So it's just saying that you have $100,000 in your bank account. So what happens is the computation here is when interest is calculated, it would only be calculated on $400,000, and that's what would be charged to the account. Now, if this was a P&I, or principal and interest loan, one of the tricks that people, or traps rather, I should say, that people fall into is when you do use an offset account, you're still required to make the same amount of repayment. So if the monthly payment, as in the previous example, was $2,637, you would still continue making that repayment amount. But if you had $100,000 in your offset account, you would actually see the interest component of that repayment would be much higher. The other way around. The principal component would be much higher, and the interest component would be lower. And that's because you are saving the interest off the home loan. So let me just recap that. If you have 100 grand sitting in offset, and your mortgage is interest payments being calculated on 400, it just means that the principal amount being reduced is higher when the actual mortgage payment is drawn from whatever account it is that you are using. So in this example, and sorry if that was a little bit confusing, don't let it be, just rewind and re-listen to that. It's really pretty straightforward. In this example, we've got, and I've had to choose a product because that's the only way this works. So let me just go back to having zero balance in the offset account. And on this particular product, the interest rate is 3.49%. We won't get hung up on that at the moment, but The repayment is $2,243 per month on $500,000 over 30 years. And what will happen when I just put some information in here in terms of the offset balance is it will readjust the actual amount of interest, and it will adjust the loan term. So on a zero balance, the loan term is 30 years, and there's a total interest of $307,276. That's if you went for the full 30-year term at that interest rate, paying your minimum monthly repayment. However, if you had $100,000 in your offset account, this is the power of offsets, it knocks off 5 years, 5.25 years off the mortgage. It takes the loan term down to 24.75 years, and it knocks the total interest paid, looks like almost half, 164,783. And let's just go back. So 307 down to 164. So not quite half, but pretty darn close. So as you can see, and as hopefully you can hear if you're not actually watching the video on this, the offset account also has some very powerful interest reduction mechanism, or is a very powerful interest reduction mechanism, and a mechanism that you can use to pay off your home loan much faster. So once again, we covered off redraw, which is putting money directly into the loan account and then being able to redraw that out at will, up to the amortized balance of the loan. And we talked about offset accounts, which the money that you have saved, or your money is being saved in a bank account, and that bank account has a feature called offset, which offsets against your home loan. I really hope that has been useful. If you're not utilizing either redraw, where you have your pay, as an example, go into the loan account, or portion of your pay go into the loan account, or if you don't have an offset account, please contact your broker. You can obviously contact us as well to review your home loan and review your structure to see how you can take advantage of these two very, very powerful features and products. Once again, my name is PJ Patterson for the Money Matters podcast. Thanks a lot for joining me.